Hi guys, Whitney here. Welcome to our weekly webinar, Passive Investing Made Simple. We're going to hang out here just a minute while our guest of honor join us here. But if this is your first time joining us, this is a live weekly show where we go through all the ins and outs of regarding passive real estate. So you can go into your first or next investment with confidence. Today, we are going to be talking about all things taxes as it relates to passive real estate investing. So I realize many of you here are probably participate in active investments as well. Feel free as we are going through today's talk to drop questions in the Q&A box. That is where I'm going to be focused on and helping moderate the conversation. But, during the recording today, we are going to answer all things related to passive real estate investing, and we will table all those questions for active real estate investing in our Ask Me Anything section of the show. Right on cue, our guests, Amanda Hahn and MacFarland with Keystone CPA. Guys, welcome. We can't hear you. Are you guys on mute?
Yes, sorry. Turned on my mic.
No problem. There you go. I was going to say, this is going to be a pretty quiet webinar.
Yeah.
Well, Amanda and Matt, as always, thank you for joining us. We have a full house today of people wanting to know the ins and outs of passive or, the tax benefits or what to expect for 2023 tax season as it relates to taxes, real estate, passive real estate. Now, I know that there have been some tax changes. I'm sure we're going to get plenty of questions, but let's go ahead and kick it off. And you guys, help recap to our audience, who you guys are, how you got into, accounting, first of all, and then your specialty skilled helping real estate investors.
Yeah. Excuse me. Well, we're so excited to be here. Tax season, of course, is upon us. So really busy here. We, in terms of like our clients, our specialty obviously is real estate. So, but we have clients kind of from both sides of the equation. So we have people who are passive investors in syndication deals. And we also have clients who are the syndicators or sponsors who are in charge of the deal. So right now we're working a lot from the sponsor side, trying to get the tax returns done, trying to get the K1s out, and soon enough we'll be working on the investor side as soon as people start getting W-2s and things like that.
Yeah, and for those of you who don't know, we are we're a husband-wife team. We've got a team of people with the great team that work with us at Keystone CPA, but we are also real estate investors ourselves. So we've got investment, active investments, we've got passive investments. So we're here to get all our questions answered. That's why we're here, right?
All their questions.
Oh, their questions.
Not
our
questions. Our questions. Where are the K1s? How much money did you make last year?
Exactly. All right. Well, let's go ahead and just kind of, do a high level overview of what are the tax benefits of investing in syndication. Like, what are just kind of like the nuts and bolts there? We've been talking a lot about at the end of the year about depreciation, but yeah, if you could just walk us through there, what are the things that the tax code affords passive investors?
There's not a whole lot of difference between active and passive investors when it comes to like deductions and depreciation. So you mentioned at the end of the year, talking about bonus depreciation as an example, right? So whether you're an active investor or a passive investor, you can claim bonus depreciation, accelerated depreciation. You can write off business related expenses for your investments, regardless of whether you're active or passive. Now, there could be a difference in terms of when you get to use some of these tax losses, depending on whether you're a real estate professional, how many hours you're spending in real estate. I think the biggest misconception people have is that if I'm just a passive investor, then I don't get to claim bonus depreciation, or I don't get to do certain things or take certain write-offs simply because I'm a passive investor. So again, the deductions, the depreciation, the eligibility to claim, those things are essentially the same. It's only a matter of timing difference on when you get to see some of those benefits if you're active versus a passive investor. But I think this time of the year, we get a lot of questions about K1s, right? When am I going to get my K1? And, what's on the K1? So I don't know if you have any FAQs you want to throw at us. We're happy to answer. Or I've also put together a PowerPoint presentation we can go over as well. However you think will make the most sense.
Well, yeah, so this is also converted into audio podcast, but yeah, like if we can keep that in mind, let's go over the PowerPoint presentation, and then that'll give everybody an option to go into the Q&A box and drop in their questions.
Okay, yeah, let's do that. Let me see if we can share screen.
Because you should have the power, but I mean, like you, a lot of the questions that we're getting, at least for me, like on the investor education side, are people, especially towards the end of the year, they're like, okay, I'm sitting down with my accountant, in the next couple of weeks going into 2023. What can I expect for losses? How is that going to offset my income from 2022? And these are such personalized questions that I'm like, you have to go back and talk to your CPA or your accountant, whoever's helping you with that larger tax strategy. But yeah,
and I think it's fair. I think it's also fair to kind of remind people too that those are good questions and discussions to have before you actually are making the investments too, right? I mean, that should be one of the first and foremost questions before someone's writing a $50,000 or $100,000 check, right? I think that's really important as well.
All right. So while you guys are getting set up, I'm going to fire off a couple questions at you guys here in the Q&A. Do you guys have any good recommendations for books on taxes for passive syndication investors?
A loaded question.
Well, I can think of two right off the top of my head.
Yes. Yes, thank you for the subtle hint, but we do have two books that we wrote. I'm trying to recall if we actually talk about syndicated deals in our books. But yeah, we wrote two books. So here we can do the subtle nod to both books, but one's more of a the book on tax strategies with savvy real estate investors, kind of the I guess our first book that we wrote, and then we have the advanced version, the light blue version, where we kind of dig into more details about certain topics like 1031 exchanges and things like that. But as Amanda was mentioning, I think a lot of the topics we talk about in there are applicable for the active or passive investor. Some of it may be, investing passively. Some of that might be being done in the background inside the syndication, like maybe they're doing a cost seg study, maybe they're maximizing depreciation or allocating things a certain way. But I think a lot of it still would apply to a lot of people for sure.
Yeah. All right. So, you mentioned like bonus depreciation. We talked at the end of last year. So just a quick update, a reminder, if you invested in syndications last year, odds are they're going to use 100% bonus depreciation. Fast forward to 2023, we still have bonus depreciation, but it is now 80%. Instead of 100%, still very, very significant, but just something to kind of keep in mind. The other thing, pass-through entity tax breaks is a big one. Again, one of the benefits of being a passive investor in syndications is that the syndication, at the syndication level is where all the tax planning and the strategies are done and implemented. So you simply get to get the benefits of it, right? So they're doing the cost segregation, they're doing all the legwork and the calculations. Pass-through entity is just a tax break that came out a couple of years ago, where if there are taxes to be paid for specific states, there are states that will allow the entity to pay taxes at the entity level, which then allows the investor to get a lower K1 amount, basically giving them the benefit for state taxes paid. Again, it's somewhat of a complicated part of the tax code, but if you're a passive investor in a syndication, odds are the planning and the filing of this strategy is done at the syndication level already. So you're simply going to get a K1 with less taxable income. when the taxes are withheld at the entity level. I think the third major change, of course, we all know about is additional funding at the IRS. So with more money at the IRS means more possible audit. So we put together a couple like tips to protect yourself in terms of possible increased audit risk. So the first one is getting tax documents. As passive investors, make sure that you are waiting for the K1s, right? Don't file your return without the K1s. I know we have some people who's just invested in a lot of syndications. They don't even know how many K1s they're expecting. But take a look, take a look at your bank account, see how many you invested in.
So that's a good point. The place to start is to know how many you've invested in.
Right. Like, don't file your return. It's like, oh my gosh, I forgot there was a K1. Then you have to go back and amend your return, and that increases, your likelihood of an audit, right?
Along the same lines, when you're getting K1s, it's not uncommon. You want to make sure you check your K1 to make sure that, taxpayer name, taxpayer ID number, what you're expecting, right? Is that you think you invested with your personal money, but it's showing your S Corp information for some reason, or vice versa, or whatever the case may be. You just want to make sure that you're taking a look at that right when you get your K1, because presumably when you get your K1, hopefully they haven't filed the return yet, and they're giving you an opportunity to kind of review it and say, hey, yeah, this looks okay with what I was, that background information at least.
We see this a lot. It's kind of like, I invested with my LLC, but the K1 is my personal name, or vice versa. So just double check all that information. If you made some changes during the year, you want to let the sponsors know, because now is when they're working on K1. So it's like, hey, well, it's for my living trust and not me. Let the sponsor know, so the K1 will come out in the right issue. What do you call it? Issue E? Payee.
Yeah. Issue.
Issuee. Communication with your tax preparer. Again, if you've made 5 different K1 syndication investments in 6 different states, let them know, because if you have to go on extension, they might have to file state extensions for you, right? So don't let it be a surprise. Now's the time to let your tax person know which syndications, what are they, where are they filing, if you haven't already told them that.
And also just, new entities. I mean, outside of just investing in other people's deals, you might have created your own new entities. That's something you want to, talk to your tax preparer about, just to make sure they've got the whole picture, right? That do I have a single member LLC we need to file in certain states, or is this a partnership, whatever it is, right?
Yeah. If your syndication wasn't your personal name last year, now it's an entity. Those are things to know too. Ownership changes. We see this sometimes through syndications too. Like, okay, I owned 100%, of this, but now it's partially owned by my mom. We've seen where there are divorces, right? So before you owned it together, and then sometime in last year there were divorces, so now we have to have 2 K1s going to 2 different people. So again, keeping that line of communication open with your sponsors, with your own CPA, just to minimize issues or mistakes, which then leads to unnecessary audits, right? Let's skip these real quick, because I think we're focusing just on the syndication or passive investor stuff. So let me skip a couple slides here and kind of get to the questions. Oh, this is important: tax return filing due dates. For all of you, so we have S Corps, partnership, LLCs. Single member LLCs are reported as part of your personal tax return. So if you have a single member LLC that's investing in different syndications, again, those are typically reported as part of your individual return, which is due in April. But if you had like a partnership that's then investing in a syndication, those returns are due by March 15th. So make sure you either file or extend by that deadline. Penalties for filing late is pretty high. I think is at $195 per owner for these. So make sure.
So I think something to note here is important is just so you have an idea of the time frame, right? So if you've invested in a partnership and it's February 1st, and you're asking where's my K1? Okay, well, let's take a step back, right? Partnership's not due to be filed until March 15th. Now maybe they've communicated they're going to try and get it done beforehand, which if they have is great. But if they told you it'll get done by March 15th, that means you're probably not going to get your K1 until March 16th at the earliest, right? So just kind of understand those timeframes in terms of, because obviously we deal with sponsors and they get these questions all the time from their investors, like, where's my K1? It's like, yes. Yeah, we it's going to be 4 weeks, right? We told you March 15th, right? Yeah. So just kind of, be aware of that, I guess.
And just so you guys know, I mean, a lot of syndications do file after March 15th. A lot of them do go on extension. It's not it's not really out of the ordinary for that to happen. Strategically, there are reasons to file extensions at the entity level, even if the return is done. So, I wouldn't be super stressed out if like the return, you don't get K1s right away. I don't know, are you seeing anything different, Whitney, in terms of the timing of when investors typically get their K1s?
Well, I think it depends on the operator, right? Like, because if the operator is a retail operator, deals mainly with retail investors, that operator probably is very incentivized to get the K1s out, as soon as possible to keep their investor base happy so they can file their personal returns. Whereas if I'm in a couple of investments that the operator is an institutional level, operator, and they're, like you said, strategically, they're going to file and extend, or they're going to extend their taxes until October. So I might not get my K1 until like August. So I think understanding what type of operator you're investing with will help inform that timeline. But two, working with your CPA, it's not that big of I found I was like, yes, I want to get my taxes done in April. It's not that big of a deal to, extend your taxes while you wait for that paperwork, because the one thing that I did learn by School of Hard Knocks, the last thing I want to do is rush as an investor, get my tax return in, and then all of a sudden at that entity level, something had to change and I get a new K1 in June or July, and now I'm refiling.
Right.
Yes,
You want to make sure that, I guess at the end of the day, the operator, if they need a couple more weeks to make sure everything is buttoned up, I's are dots, T's are crossed, no more changes. My negative advice, let that happen as the retail investor.
Yeah, and if we have time, we put together kind of some pros and cons of filing extensions. I think that's on the mind of a lot of people, so we can cover that again if we have time, or in the bonus sessions. All right, so FAQs for K1s. Why do I have such a large loss? This is one we hear all the time, like, oh my goodness, I missed $100,000, I got an $80,000 loss. This deal is doing really terribly, I've lost my money. That's typically not the case at all. On the K1, the loss you see is the tax loss. Most of the times those are created strategically, because when you invest in real estate, there are losses or there's tax benefits you can take, such as depreciation, cost segregation, all that good stuff. So odds are the property could still be cash flowing, you're doing well, but you're seeing a big loss because of the tax strategies implemented. The K1 loss, the loss you see on the K1 really doesn't have much to do with the performance of the property in general. Okay.
Yeah, along the same lines, another question we get a lot is, how are my distributions taxed? Because it could be a situation where the K1 is showing a loss on paper, rental real estate loss, but then you're also receiving distributions, you're actually getting cash. So a lot of times investors think, oh, I got a $10,000 distribution this year. That means I got to pay tax on $10,000, right? And that's actually generally not the case at all. Most of the times, the distributions themselves are not taxed. To be honest with you, it's more about what does the K1 say for rental real estate income or loss.
All right, next question. How do the K1 losses impact me? That's a big one. The answer just is going to depend, right, for each investor. So the two, I guess, common scenarios we see is if you are a real estate professional, meaning you have your own properties, that you have enough hours, more time in real estate than your job, material participation. So if you meet all those requirements, you have at least 500 hours of material participation on your own rentals, the K1 losses from passive syndications are treated the same way as your own properties, which means if you get a loss on the K1, you can use it to offset all types of different types of income. Okay. Alternatively, if you're not a real estate professional, then K1 losses are passive losses, which means it can only be used to offset passive income. Now, that's not just passive income from real estate, right? So passive income from your own rentals, from other passive real estate, but it also offsets other passive income just in general. So if you've invested in other businesses, other activities that are just generating passive income for you, these K1 losses can offset those income, even if you are passive with respect to the different activities.
Another question, I get a lot. Can I file my return without my K1?
This is like the antsy people that Whitney, you were talking about, right? Like,
I think-
get it done.
I think a better
I
way
used to be that. I no judgment. I used to be antsy myself for
to
sure.
put quotes around this is, from
These are Whitney's questions.
I think a better question is, should you file your return without your K1? You can definitely do it, but we don't recommend doing that. You should wait till you have all your K1s, as I think we mentioned earlier. So, because again, you run the risk that maybe there's something material on the K1 that you didn't report in your return. Maybe it's immaterial, maybe the numbers are zeros, but that's very rare that it has no impact at all on your tax return once you get the K1.
Yeah. Okay, the other big one, do I need to file state tax returns? We get this from clients all the time. I invested in a syndication. This syndication invested in 10 other syndications. Now I'm in 30 different states. Do I need to file state returns? Unfortunately, the answer is it depends. It depends on whether you're going to have profit or loss on the K1, and it also depends on the state. So there are states that just don't have income taxes, which is great. You'd have to file. There are states that have income tax, but the laws are different from state to state, where they say, okay, if you have profit, you have to file. If you have losses, you don't have to file. So it really depends on which states you're in. And also some sponsors will file what we call pro forma returns on your behalf as well. So anything to add to that?
No, yeah, some of those entities will file, like they're allowed to file a state tax return and pick a state, Iowa, on behalf of all the investors, maybe because, or at least all the investors who don't live in Iowa. Benefit of that is the entity is taking care of your filing requirement for you. So in those situations, you wouldn't necessarily have to file in that state tax return if that's the case. And there's reasons why they may or may not do that are, don't need to get on the nitty gritty of that, but that sometimes can happen where you'll get what's called a composite K1. That means they've filed on your behalf already.
Yep.
And
all right,
how
so the
does
next, go ahead.
I was going to say, how does the investor know that? Is that noted on the K1? And
Yeah, if a composite return is filed, you'll see it.
Yeah, it's supposed to. It should be most states have a box in there where it says, they've checked a box that says that it's a composite K1 or a composite return was filed. Sometimes it's not as clear as that. Other times we'll see where the sponsor, the syndicator, with the cover letter that they've sent to on the K1, it'll kind of mention that, or maybe the tax preparer who did the syndication return will mention that in a cover letter, something like that. But yeah, it should definitely be noted in one of those various ways.
And this is such a great question too, because it leads to something else that I just thought of, we didn't even put on here, but send all pages of your K1 package to your tax person. We oftentimes have clients send it just like the first page that has all the numbers. Because you look at the second page, it's like, okay, those are kind of just instructions or just wording, and you don't send it, but send the whole package. Sometimes the K1 package itself could be 30, 40 pages, right? Especially with like the states and all that. So send everything off to your tax person, because then they'll be able to know, was a composite filed, what were the states? Because for us, when we have like the investor clients, we see that a lot where we have to go back and say, hey, you only sent me like a couple pages of this federal return, but I know this was in like California or New York. Where's all the different state stuff? And sometimes if your tax preparer is not well versed, right, they might not even know to ask the question. So to prevent that from happening, what you can do is to send them all the pages.
So,
all right.
Can I sound it back to you? It sounds like
Yes.
it sounds like you're about to go over the different boxes of the K1, but it sounds like when an investor gets their K1, they really should be partnering with their CPA. Well, first, number one, they should be taking care and looking and making sure all the information is correct and the entity level is correct. The EINs are correct on the K1, feeding that back to the operator as quickly as possible for changes. But two, gathering everything up, partnering with their CPA or accountant, and then letting them take charge on how that gets filed on the return.
Yep, exactly. Yep, you got it. So we're sharing the actual K1 form. I guess for those people listening to the audio only, they won't see it, but you can pull it up online and take a look at it. But you're exactly right. I think what a lot of times people do is they'll get the K1 from the sponsor, and maybe they just sit on it, right? Investors just sit on it and say, let me gather up all my stuff, and maybe October or September, I'll look at it and realize, oh, that's the wrong, should have been in my LLC, not my personal name. A lot of times that's like too little too late. So as soon as you get the K1, take a look at some of these boxes and make sure it's correct. The main one is box F that we see on our screen. This is where they're listing the name of the recipient. So double check to make sure it's your name, or your entity's name, or if you invested with your retirement account, then your name should not show up here. It should be your retirement account's name, right? So it'd be self-directed IRA for the benefit of Amanda Hahn, and not just Amanda Hahn by herself. So something very important to take a look.
Another one on here that we didn't put an arrow next to, but just to mention it too, is section L at the bottom, partners capital account. Now you don't even know what a capital account is per se, but it's basically a rolling investment of your investment. But the more importantly, that line that says capital contributed during the year, if this is the first year you put money in, you put 100 grand in, that number should be $100,000, right? Not 50 or 75 or something different or something, so that's important. We'll see that not done correctly, surprisingly sometimes. Another one on the right side of the page, the top of the page, line 2, when you're investing in a rental real estate syndication, most of the time the net income or loss of your share of the net income or loss from the company is going to go up on this line. Occasionally you'll have line 1 ordinary income, but for those rental real estate ones, you would expect to see income or loss on this line. And this is the line that's going to dictate, for the most part, what if it's a positive number, you're going to include that in your tax return to pay taxes on it, unless you got things offset it. If it's a loss, then it goes back to, can you use that loss in your personal return? So that's really dictated by this line.
Mm-hmm. And then the yellow area, which is highlighted distributions, right? Like Matt said earlier, distribution is just them showing how much cash was typically cash, could be other stuff, but how much cash was typically distributed to you. So that's something you can check, right, against your records. Did this particular investment give me X dollar amount of distributions in cash? Again, this does not mean you're paying taxes on it. It's simply showing how much cash was distributed to you during the year. So yeah, on the sponsor side, when we do enter, syndication returns, we have seen some investors will match that up with the records, and just double check, like, hey, you said you gave me $2,500 of cash distribution. Maybe my bank doesn't show that. So let's see what happened. Why is there a difference? Hopefully there's no difference. Any other questions that you guys have on the K1 form itself?
Not on the K1 form. We got several other questions though for you guys. Ask me anything.
Awesome.
Yeah.
Okay. Let's stop share and then go to the questions. I think we can read it too. You want to read that?
Yeah. Or do you want to? I don't know how you want to handle it. Do you want us to kind of read them off? You want to throw them at us? Whatever works best for you.
Well, yeah, while we're still here, like on our recorded section, I really wanted to touch on, planning a little bit. Like, it's too late to plan for 2022, right? That year is done and closed and it's ended. Sorry, guys, if I'm bursting anybody's bubbles here. But really for 2023, for those people who are here listening to us, what are some of the biggest steps they can take to plan their taxes for the remaining part of the year?
Gosh, we're in January, so there's so much to do. It's basically the possibilities are endless, right? You have all year to look at, making sure you have the right ways to maximize and capture your write-offs. As a real estate investor, whether you're just passively doing investments or you're doing your own properties, or you're a syndicator or a sponsor, just making sure you have systems to track your expenses. For investors, we're the first line of defense. So if you're spending money on something and you're not capturing or tracking it, then your CPA never knows that you spent money on it, right? So I think that's first and foremost, is having those systems in place.
Yeah, and I think from any good tax planning perspective, you kind of need to understand what are my income sources going to be for the year, and how much of those what's that going to look like, right? Is it X amount of W-2? Is it, do I have a 1099 side business? How much rental real estate do I have? Am I flipping a prop? Whatever it is, right? Just being able to kind of quantify and understand what those numbers look like, because that'll that'll kind of help guide the ship, right? As to, well, if we got this type of income, we're looking to do this. If we got this, we're looking for these kind of, opportunities. And as Amanda mentioned, obviously it's early in the year, so that gives you a lot of time to kind of make adjustments as needed as you go through the year. Like, as things come up in October, maybe there's, an investment you can make at the end of the year to offset some, capital gains you had earlier in the year, something like that, right?
Yeah, I mean, we see that a lot. It's funny because just at this time of the year, we just finished out year-end planning. So year-end planning, you talk to some investors like, man, I had planned on making these investments. Now I need more investments. So just like in a hurry to try to get into deals. And you just, you prefer not to be in that scenario. So definitely, starting out planning earlier in the year, it's like, how many rentals do I want? Am I selling something? Do I need some, am I expecting some gain that I want to offset? Well, if so, let's start shopping now for some of these, what you call Whitney.
What are we shopping for?
Real estate.
Oh, okay.
I know, Whitney, you call that lazy 1031 exchange, right? So we don't have to wait until one of the assets sell to start shopping. If I know one of my syndications is going to exit this year, I can start shopping now for additional properties to create those losses.
And I think the other thing that comes to mind too is have that open line of communication with your taxpayer, CPA, letting them know what is happening this year. And it can be as simple as you opening the dialogue with an email. Because I think a lot of times they may assume that the year is going to be the same as the previous year, unless, maybe somebody tells them differently, right? So just important to kind of throw it out there as soon as possible that, yeah, hey, I'm expecting an extra $200,000 because I changed jobs or whatever it is. And, anything we should be looking at or we need to, stuff like that, right?
No, I love that. I love that little bit of nugget because for years, I was the type of person that was scrambling in like November 1st, meeting with my CPA. I'm like, okay, what do I need to do before the end of the year in order to offset all these things that I did
Right.
in the early part of the year? And then I switched that planning to like the beginning of the year. And then it really lowered the anxiety level because then I had the plan. It's like, oh, I can foresee these 6 events happening. I need to stack up another 6 events, right? Or 7 events right after that to offset my tax impact here. And
and I think also too, just looking at like, what is the best source of funding for a particular investment? Because it's not always just looking at our cash, right? If we're looking at making some passive investments, does it make more sense for me to use my retirement account? If so, is it my IRAs, my Roth, is it my 401k, or does it just make more sense for me to use my cash? And I think the answer to that question will differ from investor to investor. For some people, it's like, yeah, it's best for you to use cash or take out some cash out refi on some of your properties to do it. Whereas for other investors, maybe your 401k might be a better option to make a specific investment too, right?
It just like real estate is so individualistic, are the taxes around it. Can my regular CPA handle all of this tax planning around rental real estate, passive investing in real estate?
I think it depends. I mean, there definitely are CPAs who offer tax planning as a service. Unfortunately, that's fewer than we'd hope to see. And I think it's just the nature of the industry. Most CPAs are, one CPA probably filing 500 tax returns between now and April. So there's not a lot of time to do planning. But yeah, I would start out with asking your current person, say, hey, do you offer planning services? If so, great, they can help you with planning. If not, you can always seek out the advice of someone else to help you with planning. The person who does your planning does not have to be the same person that does your tax return filing, because they're different things, right? Planning is like making sure you're doing the right things during the year so that by next April, you have the right facts and whoever's filing the return will be able to report those facts correctly.
So how does that relationship work?
Yeah, it just kind of depends. So like for us, our focus is, although we do tax return filing, our focus is on the planning side. So, client, for example, might work with us all year round on how to do some of these things, right? Legal entities, maximizing write-offs, how do you become a real estate professional or any other tax loopholes or benefits. And once they've done the right things during the year, then if their tax filer is someone who's well-versed in real estate, they will already know, right? They'll know, okay, this is how I'm going to report all your losses. You're going to get to use that to offset different types of income. So it'll be pretty smooth. The tax preparer likes it because you would have been like the ideal client who's kind of done all the right things during the year, right? Or you have a scenario where your tax preparer maybe should have never been your preparer in the first place. They never really understood real estate. And so now that you've used all the strategies, they still don't understand what you did. And that's okay too. It just means that you have to have someone else do the actual tax filing. So for a lot of our clients who've done planning with us, then we point them in the right direction in terms of who might be a better person to do the filing, right? If your current person just ended up being someone who really wasn't a good fit to file tax returns.
Well, guys, I want to make sure we leave plenty of time for our Q&A section, the Ask Me Anything section. But two questions for you. One, how can people find you? And two, what is the biggest takeaway that you want them to get out of our talk today?
That's so funny. I don't even know if we said our company's name, but our company is Keystone CPA. That's the best place to find us. We have a lot of great resources. I know Matt mentioned the book, but we also have some great free downloadable information that you can get from there. So just go to keystonecpa.com. If you want daily tidbits of tax tips, you can also follow us on social media. I'm on there more than Matt. He's kind of allergic to social media. So you can follow me, Amanda Han CPA, on Instagram.
Yeah, I think the biggest takeaway I'd say is just, yeah, like it's be proactive. It's not, sometimes people think like taxes are the last thing I want to deal with, especially you're telling me now to deal with it throughout the year, but it's not as bad as you think it is, so be proactive, have those open lines of communication, and you'll see it can become a very smooth process for sure.
Awesome, guys. Well, thank you to everybody that's here joining live. Don't go anywhere. And if you're listening to us on your favorite podcast player of choice or on YouTube, be sure to check out Amanda and Matt at Keystone CPA. And thank you so much for spending your most valuable resource, which is your time here with us today and investing in yourself.
Thanks, Whitney.